Well, I think it's always been a base case is that once companies shed during the lockdown, clearly when the lockdown ends, I mean, I was talking to my parents and was sort of disappointed and stunned to hear they had gone out to eat in San Diego. So clearly there's an element of life coming back to normal, and that has required, parts of the lockdown to end. So it would have been unnatural. We don't know the timing of this, but when they do start to ease on the lockdown in certain large population areas, by definition, we have to see some bounce back. And as was said before as well, as the shift to more transportation jobs, delivery jobs, if anyone was sitting on workers last week, 2 weeks ago, and still wondering, why do I have this worker that we're in a crisis? I mean, what were they doing? They obviously shed as quickly as they could. So on balance, it's not unnatural at all to see some degree of recovery once everyone has shed more than all the people they need during the crisis. But the question has never been, are we going to bounce back a bit from the lows? The question is, how many of those jobs are going to be permanently lost? And if we've only recovered 11.5%, we need to be getting to 80% for people to be saying, wow, this is actually a lot better than we had thought. If we end up 40% down, 50% down, those job losses are going to create a meaningful recessionary impulse that will ultimately lead as well to disappointing behavior from corporates regarding investment. So I don't think the Fed is going to look at this and say the economy is strong by any means whatsoever, but they're doing all they can, and I doubt they're going to do much else at this stage.
Michael, I mentioned when I was at the wall, the reaction in the bond market, and we saw roughly a 20 basis point move on the 10-year yield. How concerned do you think the Fed might be about a tightening of credit conditions if markets continue to react to what they think are more bullish signs around this recovery?
Yeah, I don't think they're going to be worried because they know if conditions tighten, they will respond as necessary. But it's a natural impulse where they know the Fed's not going to do anything to stimulate anymore. The bond trade's done. And, that's what drives the dollar. That's why the euro has appreciated when they throw more stimulus, because it's not about recovery that people are pricing in. People are pricing in, what is the central bank doing to my bond holdings? And I think right now the market is just saying, okay, for the time being, the central bank's not going to do the Fed's not going to do anything more for my bond holdings, and so you back up a bit. But they'll obviously keep a close eye on this, as they have been, and they will be hyper aggressive if they feel any sort of tension in the market. But I would be surprised if they feel there's any reason to react.
Good morning, Michael. I hope you're well. Isn't there better things for the Fed to be spending its money on, or the ECB or the Bank of England to be spending their money on, rather than buying sub-investment grade passive ETFs? I can think of a dozen things that might actually stimulate economic activity more than buying junk.
Well, I think one of the things about junk, the Fed has a jobs mandate, and the companies that are rated junk are clearly the most likely to go bankrupt. So, bankruptcy is awful for jobs. So, but what the Fed is doing that I think is way too silly is just buying off-the-shelf ETFs. Clearly the companies that they need conditionality on dividends most acutely are companies that could go bust very easily. And with so many private equity holders of these junk bond issuing companies, I mean, by definition, they took an active decision to maximize risk, to maximize return. They should not be allowed, if the Fed is indirectly buying them through an ETF, to pay dividends. And people will say, oh, that's too complicated, but there's a super easy solution, is the Fed can commission its own ETF, and anyone who wants to sign up for the conditions that the Fed requires, simply not taking money out of the business is the only condition, then they will participate in the Fed ETF. So the Fed has been remarkably uncreative, and no one's pushing them. I think that what's disappointing is that they could be pumping up a market where at the same time on the other side of the trade, people are taking money out of these companies. And for high-quality companies, we can have a debate. We're having a debate here in the UK, and people still think it's abhorrent that companies that receive state aid are paying dividends. But companies that are on the cusp of possibly going bankrupt, having money stripped out of the business, is unconscionable. And the Fed needs to be doing a greater duty to resolve that problem.